So I'm Joseph Accardi, principal broker here at Ardent Mortgages, and with me today is Thomas Traplin.
As usual, the marketing manager at Ardent Mortgages.
We recorded our last video a little while ago.
Days ago.
Swear, yeah. Definitely not just a minute ago. And this is video number 2. You'll notice that I'm wearing the same outfit exactly, and so is Tom. Coincidence.
Yeah, we just wear the same thing every day.
That's not true. Let's not say that ever again. Anyway.
Sure.
What are we here to talk about today?
Today, we're talking about 5 good reasons to refinance a mortgage. Excellent. As opposed to the 5 bad reasons.
Yes.
These are good ones.
All right.
Well, let's get into the good ones. Let's talk about it. Reason number 1, interest rates are going up.
This one's a fantastic
100%.
reason. So first things first, disclaimer, we don't know for sure if the interest rates are going up or not. All signs indicate the interest rates are going up. That being said, rates have gone up already.
We're not soothsayers. We can't see the future.
That's right.
Just, don't sue us.
With that in mind, of course, we've seen rates go up a few times already this year. And we've also seen a large indication from FSCO saying that now there's this new stress test that they've put into place here, right?
Yeah.
And there's been a lot of conversation about the stress test and other things like that as well. But with that, now with rates going up as well, it's getting harder and harder, obviously, to qualify for mortgages. So taking this back to the good reason, interest rates are going up. Right now, if you were to look at qualifying for a mortgage, you would not qualify for nearly as much as you qualified for 6 months ago, let's say.
Yep.
So when you need money, let me rephrase this. When you need money, that's always the worst time to have to apply for money, because that's when you're already in pretty desperate situations. So everybody has quite a bit of equity in their home right now, depending on how long ago you purchased your home. House prices, as we indicated in the last video, have been going up and up and up. This is the best opportunity for everybody to get a line of credit and just sit on it. You don't need to do anything with it, but then you've got the largest amount of equity that you can draw from in the event of an emergency, where you may not necessarily qualify for it in 3, 6, 12 months, whatever the case may be. So now is the time to do that.
The stress test is a reasonable indicator that maybe rates will be 2% higher sometime in the relatively near future. Otherwise, why would they do the stress test?
Here's a question for everybody to think about. What happens when the stress test is still in place in a year from now or 2 years from now, and the rates are 2% higher? What does that do for what you can qualify for? You're qualifying for an extra 4% on top of what you can qualify for right now. Think about what that does think about how that would impact your income to qualify for the same dollar amount. And we can post some stats about this underneath. I'm pretty confident. I don't want to get into it. I don't have any of the raw material right in front of me right now. But
yeah, we'll figure something out. This will
be
in the description down below.
Yep.
All right, so that's reason number 1. Reason number 2, good reason. You want to consolidate some debts.
Wait a minute.
This sounds like we've done this before, and it was a bad reason. So why is this a good reason?
So again, the game plan is everything when it comes to consolidating debts. And like I mentioned in video number 1, consolidating debts on its own is not a bad idea for a refinance, as long as you have a game plan where you're not going to tap back into that available credit and fall into the same bad habits. I've worked with clients where I've saved one client was saving about $6,000 per month. That's probably
bananas.
The most extreme situation. But typically speaking, the clients that I work with, by consolidating debts, are saving anywhere between $500 to $2,000 per month. That's major cash flow savings. With that kind of savings, you shouldn't need to dip back into your credit cards or lines of credits or borrow from payday loans or other companies like that.
Yeah.
So it's a really good idea to clean up your credit and improve your cash flow.
Let's go to reason number 3. You want to pay off your loan a little bit faster. Why is this a good reason?
This is one of the best reasons. A lot of people don't really understand how loans reflect on the credit bureau and when they actually start to have a positive impact on your credit bureau.
Mm-hmm.
So to get into this in a video as quickly as possible.
We'll keep it simple.
The rule of thumb is if you have a trade reporting to the credit bureau that has a balance over 50% of the limit, it has so if it has a balance over 50% of the limit, anytime the balance is over 50%, it actually has a negative impact on your credit score. The only time it's improving your credit is when it has a credit score, or when it has a balance less than 50% of the limit.
Yep.
And then that scales with the total dollar amount of available credit and amount borrowed, right?
Yeah, so the closer you are to your absolute limit, if you are maxed out, you are getting the maximum negative monthly impact.
That's right. And you get positive points for making your payments on time and other things like that. But the high balance can easily offset that positive score. And those aren't the only things that contribute to your credit bureau, of course. But it's really important so how this relates back to the paying off your loan faster. Well, if you have a $10,000 loan at a high interest rate and let's say it's amortized, so you're going to pay it off over 5 years or 10 years or something along those lines. Let's use 10 years just for the sake of this argument.
10%.
You might, so $10,000, 10 years. You might not actually get down to the 50% mark of that loan until year 7, right? That's 7 years that is actually having a negative impact on your credit score, not a positive impact.
Yeah, because the key factor is the fact that as soon as you take out your loan, it's considered to be maxed out.
And we're not talking about a small dollar amount at this point anymore. It's not like it's a $2,000 credit card. You're talking about a $10,000 loan. So the moment that is reflected as a $0 balance, that's when your credit score starts to very, very quickly and dramatically increase.
So that's a great reason to potentially get some money out of your equity. Let's go to number 4, though. And again, I feel like we've had a little deja vu.
Are these the same reasons as the reasons?
These are all the exact same reasons. Nope, we haven't changed a thing. Reason number 4, you want to do some renovations on your home. This was a bad reason before, but now it's a good one.
So I think in the last video we explained also why this was a good reason. Sometimes you have no other option but to dip into the equity of your home to do some renovations, right? If you have roof repairs that you can't afford to do right now, and this might cause major damage to your home in the future if you don't do it.
Sure.
Same idea with a driveway. Your driveway has deteriorated, might cause damage to your vehicle, potholes, other issues like that on the driveway, or just danger to children playing in the driveway or other items like that.
Some things are necessities.
Yeah, so the necessities, if you don't have the money to do it and you don't have the plan in place to save up for it, and you haven't saved up the money already, sometimes the only option is to dip into the equity of your home.
I would also note that some renovations actually add value to your house. So if you can actually, just hypothetically, if you can take out $20,000 to remodel your kitchen or do something along those lines, and it adds $30,000 to the value of your house, it's actually not the worst use of your money, because you are actually increasing the value of your home. You're not just flat, or you're not losing money by just, repainting your house. It doesn't add any value. You're not just adding debt for that reason.
That's true as well. Yes. It's a little bit more risky than
for sure
than the other items here. Well, the other items aren't really risky. They're just necessities. But yes, if you have a renovation project in mind and you don't have any other way to finance it and it's going to add that value, then yes, that's a great option.
All right, well, reason number 5, and it's something we alluded to at the very end of our video previously, you want to invest some of that money.
And this is, with rates being as low as they are right now, this is one of the best reasons to dip into the equity of your home, especially with, as we mentioned again in the previous videos, and I wonder if this is going to be a recurring theme or not.
It might be.
But with the price of houses increasing and increasing in the market that we've been in, there's a lot of available equity for people, and a lot of people don't know what their options are to do, like what they can do with that equity. Taking that money out to invest it in real estate, to invest it in a rental property, real estate, to invest it in any sort of investment product where there's a close to guaranteed return. You can never say guaranteed return, right? But if you can borrow from your home at 4% and reinvest it somewhere else at 8%, like I indicated in the last video, you can write off the interest on your taxes. You're making an 8%, well, you're making a 4% spread, 8% yield on the investment. There's very few other opportunities to make that kind of return on an investment. And we have a lending partner that we work with that if anyone is interested in, they can contact us about, and we can point them in the right direction to invest at that type of return.
Yeah, another great option. Take out some of that equity and get your money to start making money for you. Start putting it to work.
That's correct.
Because there's no point in just sitting on some value if it's not going to do anything for you.
Mm-hmm.
Okay. Well, those are some pretty good reasons.
Excellent.
I think those are 5 good reasons to refinance your mortgage.
Agreed.
All right. Well, thanks for joining us for this second excellent video that we've shot so far. We really appreciate it. How about you?
I agree. Thank you guys for joining us, and please feel free to contact us with any questions that you have, any ideas for future videos, anything like that. We're always
absolutely always
listening.
Open to questions, and we would love to answer them. And going to do that YouTube thing. Don't forget to like, comment, and subscribe. Forgot to mention that in the last one, because that's important.
We'll put a little
one
of those again.
Yeah.
Wait, maybe here.
Somewhere around there. But you know what to do.
All right.
We'll see you guys again next time.
See you next time. We'll just end it with that clap.